welcome back. You're watching The Money Show with me, Kavita Thapliyal. As the current financial year inches closer to its end, so is your last opportunity to save tax on your income this year. After 31st March, taxpayers won't be able to use different tax-saving instruments to reduce taxes on their income. So here is the last moment check to make the optimum use of tax-saving tools. Let's welcome on board Alok Agrawal, partner, Deloitte India, to take the discussion forward. Alok, good evening. Welcome to the show. But then before I start asking you the questions, let's, in a nutshell, get the gist of all the tax-saving options available in this video. All right, 31st March is around the corner, and it's very important for you to know that what all tax-saving instruments can be added to your tax-saving instrument list, because here is where you get the tax-saving benefit. Let's start with health insurance and life insurance. Health insurance, you get a benefit as per Section 80D, and for your life insurance, you get a benefit as per 80C. A senior citizen or individual health insurance premium can be claimed for tax benefit as per Section 80D. We move on and let's talk about your retirement tool investment instrument, where you get a tax benefit, which is NPS. As per Section 80C, you get a benefit of 1.5 lakh. As per Section 80CCD, you get a benefit of extra 50,000, which means all in all 2 lakh rupees tax benefit you get if at all you invest in NPS. Next, let's talk about Provident Fund. As per Section 80C, you can get a tax benefit of 1.5 lakh in PPF. And after that, Sukanya Samriddhi Yojana, this is eligible under Section 80C. You want to invest for your girl child's education, her marriage. Sukanya Samriddhi Yojana, SSY as we all call it. Here you can claim the benefit of 1.5 lakh as per 80C. Next, we talk about tax-free fixed deposits. So very famous among a lot of people who use this investment instrument to park in their money. Also conservative investors, and they also get a tax benefit. In the end, let's talk about senior citizen savings scheme, where again you get a tax benefit under 80C. And you really need to hurry up if at all this is something that you really want to claim as per your tax saving instrument. Equity linked savings scheme, which is ELSS, where you also park in your money and get market based return. There's a lock-in for 3 years, tax benefit as per 80C, 1.5 lakh benefit. You also have ULIP, which is unit linked insurance plan. There is a 5 years period of lock-in as per this particular investment instrument, and the premiums, on the premiums you get a benefit as per Section 80C. And in the end, we should talk about charity that you've done, and over there deduction under Section 80G for income donated to charitable organizations can be availed. So in a nutshell, these are the investment instruments on which you can get tax benefits, or you can claim tax benefits as per different sections. All right, Alok, a lot of your work already done over here, it seems. But then let's analyze this entire situation with respect to the new tax regime also, which will kick in from 1st April. Okay, so all of these tax benefits you will lose if at all you are shifting to the new tax regime, because this is going to be your by default tax regime now. But then before that, quickly, I want to understand from you, how can we, if we are an old tax regime taxpayer, how can we include one of the best tax saving instruments mentioned in this list?
Sure, Kavita. So, as you said, the first assumption here is that in order to take benefit of these tax saving investments and other kind of payments, I need to be in the old tax regime even for the financial year ending March 2023. If I had determined after comparing the two scenarios that I'm better off under the new tax regime, then obviously all these are going to be irrelevant for me. But let's talk about those individuals who had determined that they are going to be better off under the old tax regime. So let's say overall exemptions and deductions over more than 2.5 lakhs, generally those taxpayers would be better off. So for those individuals, if they have not already done whatever they could in terms of Section 80C deduction or 80CCD deduction or 80G, as you said, or 80D for health insurance, they can still do it to the extent it is practically feasible. They still are 4 days left for for the end of this year. They can also look at what was considered by the employer from a payroll withholding perspective in order to determine the balance that they need to invest. Because as we all know, the total limit under Section 80C is only 1.5 lakhs. So let's assume that you already have Provident Fund contribution under your salary, which is meeting that limit, then 80C is already taken care of. Then you can look at some of the others of NPS under 80CCD or health insurance under 80D, or as we discussed, donation under 80G if you would like to make donations, because that's more of a deduction for an expense you're incurring rather than an investment.
Right, Alok, let's also talk about the major changes. I think it's very important for us to brush up the new tax regime and the kind of tax slabs now which are as per the new tax regime for all those investors who maybe want to sit and decide as to what kind of tax regime is better for them. So if you could just revise the tax slabs and the kind of benefits we are getting in the new tax regime.
Sure, Kavita. So, like we had discussed after the budget announcements, for people under the new tax regime, it has become a relatively more attractive situation in FY 23-24 as compared to the new tax regime for, let's say, FY 22-23. So, one is you have a higher rebate for income up to 7 lakhs per annum. If you have income up to that, plus you get a standard deduction as well, so 7,50,000 effectively, you will not have any taxes. Then the other end of the spectrum, which is very high income taxpayers above 5 crores, they also have a big benefit under the new tax regime, because now the surcharge is limited to 25% as compared to 37%. But this is again under the new tax regime. Sorry. Now, there are some benefits even in between. So let's say, for the 12.5 to 15 lakh, earlier it was 25%, now it is 20%. So effectively, there is some tax saving. Again, if I have to give an overall number, you have a total of, let's say, 3.75 lakhs of exemptions and deductions, plus you're getting 50,000 of standard deductions, so 4.25 lakhs in all. If you have that or more, then you are again better off under the old tax regime. So the two main changes, as we discussed, was standard deduction was allowed under the new tax regime, and you have a deduction of up to 15,000 even for family pension. So Kavita, these are the main changes as far as the new tax regime is concerned. And the other thing, as you rightly said, is unlike FY 22-23, in FY 23-24, the new tax regime becomes a default. So let's say from a employer TDS purpose, the employer will automatically consider the new tax regime unless, as an employee, I submit my choice to the employer that I want to stay under the old tax regime for FY 23-24.
So one last question to you on the benefit that one will lose on debt mutual funds. How to make the most of it and how to make the most of this time till 31st if at all you want to invest in fixed income like a debt mutual fund. Will we be getting the benefit of LTCG plus indexation if we do it before 31st?
That's right, Kavita. So this was something which was introduced in the final finance bill that was passed a few days ago, now becoming the law of the land. So what they have done is they have added debt mutual funds along with market-linked debentures to treat both in a similar manner. And now both will be taxed as short-term capital gains regardless of the holding period. But this change is effective only from April for investments made from April 1, 2023. And therefore, if you make investments into debt mutual funds, and we have to be clear about the categorization as well of debt mutual funds. So we are talking about where the equity holding in domestic companies is 35% or less. If we are doing that, then you will still get the 3-year period to make it a long-term gain. You'll get the 20% indexation. But if you are making those investments from 1st April onwards, then as we discussed, it's all going to be short-term gain, similar to what was proposed in the budget for market-linked debentures.
So this was all about your last minute tax planning and also things to keep in mind from 1st April. Thank you so much, Alok Agrawal, for being on the show, helping our viewers on that today.